We have quite an esteemed panel. I don't know if you guys realize, but this is sort of the global leaders in marketplace lending are all on this stage. And I think we are very lucky to have such an esteemed panel. And I would like just to start off with everybody just introducing themselves, telling the audience a little bit about your company. And in particular, I just want to focus, when you're doing your introduction, who are the borrowers that you're attracting onto your platform? And Tom, why don't we start with you?
Well, good afternoon, everybody. I'm Tom Green from Lending Club. We're the world's largest online marketplace lender. We started in 2006, and what we do is we connect borrowers and investors. So investors can directly loan money to those borrowers. We've done around 11 billion in loans to date, and we're doing about 7.6 billion in loans this year. So we've got really big.
And who are the borrowers?
And the borrowers, we lend to a few types of people. So we lend to consumers who come to us with an average FICO score of about 700. They come to us primarily to pay off existing credit card debt, an average of about $14,000. And they save a lot of money and they get the debt paid off more quickly. We also have small business borrowers, and we have borrowers who come to us to finance education and medical procedures.
I'm Sam Hodges. I'm a co-founder and run the U.S. business for Funding Circle. Funding Circle is a global marketplace for small business loans. We've been around for about 5 years. Inception to date have lent out about $1.5 billion and are currently lending out about $100 million per month. Our sole focus is on getting credit into the hands of great small business owners. So our average borrower here in the UK is a business that's been around for between 5 and 10 years, has on average between $1 and $3 million in revenue, and on average is looking for between $100,000 and $150,000 in order to expand.
Hi, I'm Joanne Bradford. I'm the COO of SoFi, and we're a marketplace lender. This year, we have done about $4 billion in loans to date. And we really build a sense of community amongst our borrowers. We started with student loans. We've moved to personal loans and mortgages. And we help our members with everything from, we've helped 140 of our folks with student loans get new jobs. We have career counseling for them. We do community outreach and events because we want people to love SoFi and think about it in new ways. So really, it's community first, and I've been there a couple of months, and I came from Pinterest.
Good afternoon. My name is Eric Thaller. I'm with Prosper Marketplace. We are a marketplace lender focused on the unsecured consumer space. We don't participate in any other market. It's solely focused on that space. Our prime customer is a borrower with a FICO score north of 700. It's someone with $80,000 plus in income and around 40 years of age. We have originated just under $5 billion since inception. We're tracking about $1 billion a quarter.
Okay, so that's one side of the marketplace is the borrowers. I'd also like to go down each of you and ask, who is on the other side of the marketplace? Who are the people that are funding, or the entities funding the loans? Why don't you start off with you, Eric?
Sure. So our platform is split into retail and institutional capital. Obviously, we have customers, investors coming direct to our site to fund individual loans or fractions of loans. We also have a large group of institutional investors. And that's a very broad, diverse group of investors. Some of the early participants were the hedge funds and large BDCs, but now we've transitioned to what I would call a lower cost of capital investor that includes some of the real money, large asset management firms, some banks, family offices, and through the securitization market, now you're even seeing some plan sponsors, pension plans get involved in the space.
Great. We've got first-class institutional and hedge funds with us today, and eventually we'll move into probably a retail environment.
I think similar to Lending Club and Prosper at Funding Circle, our marketplace is split between fractional market where individuals are buying pieces of loans, and then an institutional whole loan market. Within the institutional whole loan market, the mix of investors range from credit hedge funds to large asset managers to real money pools and also banks.
We ask individuals to lend to strangers on the internet. That's how we got started back in 2007. They did it, and we've actually tried to stay as true as that as possible. So actually, that still remains. Individuals remain 70% of our funding mix, and institutions such as hedge funds and banks is the other 30%.
Okay, so I want to actually a question for you, Tom. Lending Club have done over $10 billion, over $11 billion, and it's not an insignificant amount. It's not huge like some of the major banks, but I'm curious to get your take on what you think. As of now, how has Lending Club changed the financial system? What is it doing that is different?
Yeah, and it's not just the 880,000 people that we've lent to at lower rates than they would otherwise have got, which has helped them to achieve their financial goals, or the many, many thousands of investors that we've helped. It's really, if you just take a step back and think about innovation in banking, innovation has really often within banking actually come from outside of the industry. So if you would indulge me, I'll tell a quick story. Sure. It's about the invention of the credit card. This was in the 50s in New York. Frank McNamara offered to take his wife out to dinner. And they got there, and then the bill came, and it turned out he'd forgotten his wallet. That's his story, and he's sticking to it. Now, what he actually did up to that point was he decided to invent a way to pay without cash. And so he invented the Diners Club card, so people could pay in restaurants in New York City. And that came from outside of the banking industry. And so this is the same thing that we're doing. We're bringing down costs, we're delivering a better customer experience, and it's coming from outside the banking industry, but we're working with the banking industry to bring those benefits to a very broad range of people across the entire system. And as you said, we've done 11 billion in loans. There's over 11 trillion in assets out there. So we can get 1,000 times bigger, I suppose, theoretically. But yeah, there's a long runway for us to go in terms of having further impact on the financial system.
Okay, and then Joanne, what about with SoFi? You guys have brought along a lot of innovation. You really invented the student loan refinancing business. What are you doing that is different? What are you doing as far as there's been private student lenders out there for a long, long time, but what are you doing that's different?
Well, first of all, we give them a really great rate, and then we've taken a lot of the friction out of the process, and that they can do it quickly. It only takes a couple of minutes. It takes a couple of days to process it. So it's not where it used to be piles of paper. You could actually sit down on your mobile phone and take pictures of your documents and upload them all and do it inside your car if you wanted to. And people think about their finances in that way. They think about things on the go. They do it in pieces. They want to be able to call someone. They want to be able to do it on their mobile device. They want to be able to access everything. And that's innovation that hasn't happened before, and nobody's really wanted to take that on in a big way. So that's what we hear, number one. And then we give them value back in some membership privileges that they have, and creating a sense of community. So we literally did a dinner last night in Boston, and they sent me videos. There's a guy who runs a charter school fundraising system who got his master's in education and was so happy that he refinanced his student loans with SoFi that he was then able to have enough confidence in his new financial stability that he was able to propose to his girlfriend. And so, I don't know. I try to think about people as people, and what they really need. And financial confidence is a big deal to people today. And so we try to give it to them in ways that they can digest it and understand it, and doesn't put a ton of acronyms in it, and makes them feel good and safe. I went up to to Healdsburg, where our call center is, and listened to a bunch of calls. And a lot of people just call up and they're like, look, I want to know, can I really do this? And it's like, yeah, you can. And they're like, okay, great. And they hang up the phone and they do it. So, you know, there's a whole confidence that needs to happen. You know, a lot of people just don't have that. And that's one of the things that we're trying to do, from ease of use and speed. And that comes down to a lot of technology innovation.
Okay, so speaking of confidence, Sam, I wanted to ask you about the small business landscape, because running a small business, going to get a loan from a bank has always been difficult, and I think a lot of small businesses just don't even bother, because it's just let's just throw it on the credit card and we'll just make do with what we can get there. So how are you? What are you doing as a company that really turns the sort of business application on its head?
So for us, it really comes down to three things. It's about speed, it's about fairness of price, or kind of value of price, and overall kind of quality of experience. So let me kind of break those out. You know, I guess I come at this from the perspective of someone who's run a small business, as I'm sure many of you have. Going through a bank process where you literally, you know, fill out forms in triplicate and then have them faxed into a central processing center and then wait weeks or months in order to get a decision, and you don't actually get to talk to a decision maker, is just an incredibly frustrating, very slow process. And so when we first started the company in the US, one of the things we were very focused on is actually making the process much more transparent and much faster. So we can turn around a small business credit application in a matter of days. Typically a borrower will actually get money in the bank inside of a week. And then the other piece of it is around the actual price of that credit. You know, as we look out at the landscape for those small businesses who are not well served by the banking system, which is frankly most of them, there are lots of options, but those options are incredibly expensive. And they're also very opaque. There's a whole corner of the small business lending market where the APRs are north of 50%, and yet they're advertised as factor products with, you know, a 6% rate. And as a small business owner, it's actually very confusing. So for us, you know, our loans are priced between 5.5% and 24%. We disclose all of that very openly for the borrower. We'll give them an APR. We'll also show them what the monthly actual cash impact on the business will be. So if you're a small business owner, you can get the credit quickly. You can make sure the product is a good fit for what you're doing, and you actually get really high quality service along the way.
I just want to build on something Sam said there. You mentioned factor rates. There's a ton of small business lenders out there doing the following thing. What they do is they come to your small business and they say, I'm going to give you $100,000 and you're going to pay me back $120,000. Does that sound like 20% to anybody? Because it certainly sounds like 20% to a lot of small business owners. It sounds like a rate that may be comparable with a credit card rate. But what that rate actually is, if you pay it back over the course of a year, is much higher. And here's why. Because if you're paying interest, you're paying it on a declining balance. Whereas if you're paying 20% on the 100,000, you're paying it on the entire amount up front. So it's almost a 40% rate if it's paid back over a year. And what some of them do is even worse. What they'll do is they'll tell you, pay me back in 6 months or 9 months. Well, that makes the effective annualized interest rate north of 50%. And yet they think they're paying 20%, and it can send them under. And so what Sam and I and some of the other companies in the industry did is we came up with this thing called the Small Business Borrower's Bill of Rights, which is a set of self-regulation principles that talk about transparency and fairness and good underwriting practices and really helping small businesses fundamentally to get a product that's good for them. And that sounds like something that you would think that other people would want to do in this business, but actually that's a new thing in small business lending, getting small businesses a product that's good for them. And so we feel very passionately that that's something that's really important, and that's why the growth of our businesses is so important for the financial system in general.
Yeah, that's a very good point, Tom. I think the Small Business Borrower's Bill of Rights is essential. In my opinion, we've got with small businesses there is so few regulations when it comes to what a small business owner has to pay. So there are some companies that will take advantage. These are steps that you couldn't take in the consumer space, simply because there are much more rigorous regulations in place. So I wanted to actually just, Eric, touch on the regulatory piece. How is Prosper and the consumer lenders regulated? People sometimes come along and think, well, these are non-banks, therefore they're unregulated. Can you explain what sort of regulations apply to companies like Prosper?
Sure. I mean, there has of course been some financial press that has indicated this is really regulatory arbitrage, but I would submit it's actually quite the opposite. We are regulated quite heavily. In fact, Prosper is a publicly filing company, even though it's public, and the reason for that is because we file an S1 with the SEC every day for our fractional note platform. Additionally, our originating bank is regulated by the FDIC, and so we are compliant with all the regulations that are associated with that. And that includes bank secrecy, truth in lending, fair lending, et cetera. So there really is quite a swath of compliance that's required from marketplace lenders. And it really isn't the case that there is no regulation in this industry. One of the things I think is really important to touch on is the level of transparency that these platforms deliver into the marketplace, which I think is quite different than a lot of other finance businesses. We do provide a significant amount of data both to our borrowers, but also to our investors. And I think that provides a level of comfort in these new businesses, and also provides a level of simplicity that allows people to understand the products we're delivering into the marketplace.
Okay, so I want to just talk about the thing like Tom mentioned earlier. We're lending to strangers over the internet. It sounds dubious. It sounds like it's going to have massive defaults, and it's really going to be a very high risk investment. But I want to start with you, Joanne, at SoFi. If you could, SoFi, and I've said this publicly, other people have said it. I mean, has probably the highest quality loan book on the planet of any company. That is any bank, anybody. I would argue that a company like SoFi probably has the best loan book. Can you explain? Can you just share how many loans you've done and how many defaults that you've had in the history of SoFi?
The default number is almost single digits, it's just the quality of the process and the underwriting process. We don't go into all the details of that, but and I don't come from that business, so I'm not an expert at it, but I've spent a lot of time on it over the last couple of months, and I can tell you that the quality parameters, how we think about it, and the funnel that we drive from a marketing perspective is a lot of what drives that quality. We don't go market to everybody in the entire world, so we're trying to really qualify our customer before they come to us and give them the right information so when they come to us. So that's one step in it, and then serving them quickly and telling them whether they're qualified or not, and then giving them that loan quickly, and then all of the underwriting practices, which you guys know more about than I would, but soon I'll be an expert.
Well, and just to be clear with everybody, so that single-digit number of defaults with, I don't know how many loans you're up to now, like 25,000 loans or something like that. It's
more than that.
Yeah. So it's like
a lot more than that.
A lot. So that's more than 25,000 loans, single-digit defaults. That's not percentage. That's total number of loans out of tens of thousands.
Just one of the other principles is when we loan to someone, we usually think that we've figured out that they're highly employable, and that a lot of people come upon difficult times in their life. Companies change, and so helping them get jobs helps them pay back their loans. So everything that we do is really to keep the quality of that high. We don't have an outplacement team because we think it's just cute. We do it because we really think that keeping them employed keeps the quality of it high. So we've helped 140 people get jobs that have lost their jobs, and we tap into the network that we have. And it's super easy to help them. It just takes a little bit of coordination.
And what about small business? I mean, that's a historically very risky endeavor, starting a small business and even taking a loan out. What are the defaults like? We'll start with you, Sam.
So I guess the first thing I'd say about small business is very fragmented, right? In the U.S., there are 28 million small businesses, kind of depending on how you count. Of those 28 million, somewhere between 5 and 6 million have physical locations and employees. And it's really that part of the market where we make loans. So these are not generally true startups, rather these are businesses that have been around for years. They've got real revenue, they've got some cash flow, and what they're looking for is expansion capital. And so similar to, I think, how SoFi thinks about it, the first thing you have to do is just make sure your approach from a credit perspective lines up well with the part of the market that you're trying to serve. The second thing we do is bring a lot of data and analytics to bear in how we underwrite and evaluate those small businesses. And so, unfortunately, we're not able to serve with our current product set 100% of folks who come to us. We serve a subset, and only those where we really understand kind of the probability of default and loss expectations. And based on our track record in doing that, what we're able to do is actually have loss levels between 2 and 3% on an annualized basis. So if you think about that relative to most other digital SME lenders, it's a very low level. And given where we're pricing the loans, it means that the vast majority of our investors are making very healthy returns.
And Tom, what about you? And how is it? Can you just give people a bit of a, because you guys are doing small business and consumer. What are the defaults like, and how are they different between the two classes?
Traditionally, small business loans have had higher default rates in recessions, and so consumer default rates go up in recessions. Small business default rates go up even higher in recessions. In the credit environment we're in right now, we're actually seeing pretty comparable default rates across the two. It's a very, very healthy risk performance. Similar to what Sam said, I mean, we use as much data as we can to make sure that we can identify the credit-worthy small businesses, and we don't lend to startups, which are by far the riskiest small businesses. We also use partner data where we can to underwrite businesses. So, for example, we've got a partnership with Alibaba where we lend to the US-based small businesses on the Alibaba platform. There's data that comes with that partnership that helps us to figure out which of those businesses are creditworthy, and so we love to do as much of that as possible.
Okay, so Eric, turning back to you, I just got to ask you about the news that you guys announced this morning. I wrote about it on Lend Academy, and Prosper did an acquisition. Could you just share what the acquisition was and why you guys did it?
Sure. So this morning we announced the acquisition of BillGuard, which is a personal financial management company in Israel. They have an application that is focused on security and fraud. And we think really the key here is the ability to acquire customers and engage with the customer. And traditionally, the platforms up on the dais have really used direct mail, partnerships, affiliates. They really haven't had their own acquisition channel. And this is our first foray into building that direct line to the consumer, and really being able to engage the customer beyond that single transaction and to develop a relationship with that customer over time. So BillGuard has already 1.3 million customers. They offer a freemium app into the marketplace. We will integrate that into Prosper, and we think it's a very unique way to deliver customer acquisition for our investors.
Okay, before we turn it over to the audience, I wanted to ask you a question that I think is something that we may have to deal with at some point. So I want to paint a scenario where we wake up tomorrow morning and we hear that a big bank, let's just say it's Wells Fargo, for example, have bought a startup platform and plan to pour billions of dollars into marketplace lending. What do you guys react? We'll start with you, Tom. What do you do?
Well, first of all, Wells Fargo is already one of our biggest investors. They, through one of their venture funds, they've already backed marketplace lending, and they believe in it, which we're flattered that they're backing us.
Let's call it Chase then.
So, second, I think first of all, the idea that that a huge bank would make a huge investment in marketplace lending like that, I think first of all we'd be flattered, right? I mean, they would see the potential in this model, finally, that and they would want to participate in it. So that's great. Secondly, I would wish them the very best of luck, which I think they would really need in building a low-cost model within the construct of a bank, in building a customer-friendly experience within the construct of a bank, and finally, in building a technology company within the construct of a bank, context of a bank. So I would wish them the best of luck with all of those three things, and I would wish them success.
So it doesn't sound like you're worried about that. So, and this is not...
I was actually planning to get up in the afternoon tomorrow. So.
Okay. Well, and it's actually, while it is a, I asked a theoretical question there. We have heard like Goldman Sachs has talked about coming into this space. Obviously, got some of the deepest pockets of any financial institution, and could, if they wanted to, really make a splash. So Eric, back over to you. What do you? How do you compete with Goldman Sachs or Chase or Wells Fargo, who really want to put billions of dollars to work here?
Well, actually, Chase is an investor in Prosper, so. But again, I don't really think I have too much to add beyond what Sam said. Of course, it would be an incredible validation for the space. There's a lot of experience and intelligence that's been learned, over the years that have been in practice, and I don't think that's something that can be generated overnight. That being said, of course, we take any entrant into the space with seriousness, but we've developed a core expertise that we think will allow us to continue delivering product into the marketplace that'll be competitive. And I don't think this is a winner-take-all market, as was suggested in the last presentation.
Yep, and so Joanne, with SoFi, like there are banks competing directly with you today. I mean, they're in the student loan refinancing. How are you competing with those guys, and how are you? You're really the gorilla, and the banks are really the sort of upstarts in some ways, because you seem to have such a large market share. How are you competing with banks today?
Well, let me just first answer the question if that happened. I have come from the advertising business, which is a baby in comparison to the financial services business in size and opportunity. So I'm glad to be here. And I would just remind you of News Corp buying MySpace, right? I mean, you can't innovate, and they thought that they had the answer, and Facebook came around, and so single focus and being able to innovate and invest and having one purpose. So if a big bank tomorrow said they're going to put billions in or buy someone, I still think standing alone in your purpose for a little while makes you much stronger, and I have many examples of that from working at Yahoo and Microsoft, and even at Pinterest, where single-minded focus really helps you. So that's how I just philosophically think about that. And then, competing with banks, people don't love banks. They really don't. It's one of the things that attracted me to SoFi is our founder CEO, Mike Cagney, is like, look, like nobody likes their bank. Nobody really has a great relationship with their bank. And so we think there's a lot of opportunity to rethink that entire model. And that's what we've done. And we've started with a really underserved, pissed off group of people, and we've made them happier with a better product. And then we moved on to other segments. Our mortgage product, you can put 10% down, right? Like everybody in this room that needs to buy a house in the Bay Area, I know you don't have 20 or 30 or 50% to put down. You can come to SoFi and get a great mortgage and put only 10% down. And so that's serving a market and a need. And we think you're a great investment, and we know you'll pay for your house and you'll love your house. And so, a bank doesn't think that way. So we just think about it very differently. I don't get up every day and think about banks. I get up every day and think, oh my gosh, we should serve this group of great people that we should invest in and give them great products. Student loans were first, personal loans second, mortgages third, and there's a list of many more that we think about every day. And there's plenty of opportunity. We don't think about rivals. We think really more about serving that group of consumers. And so everybody here that doesn't have a home, get a 10% down mortgage.
Okay, end of pitch.
Right? I mean, really, right?
Sam, do you want to add to the...
Sure. I mean, I agree with what the others have said. And I guess I look at the question a little bit differently and maybe frame it as, what does this space mean for banks, right? It's kind of a different way of asking the question. From our perspective, we already are partnering with many banks in lots of different ways. And we've talked to, I think, over 200 banks across the US and the UK about how potentially we team up. And overwhelmingly, what we've heard from those banks is, we'd love to partner. We'd love to figure out a way to send you borrowers we can't serve. Maybe you can process those loans on our behalf. Maybe we can lend through you directly. Maybe we can actually provide processing services kind of underlying the systems and technology. Maybe there's a JV opportunity where we go after a consumer that neither of us currently are going after. So I don't think that what we're doing is at all an existential threat to most banks. And frankly, from talking to banks, I think they view most of us as being an opportunity to team up with someone that has things to bring to bear that they may not have themselves.
Fair enough. Well, let's open it up for audience questions. Anybody?
Hi, this question is for Sam. You just talk about data. So there's a lot of loan level data available out there, right, for all of you guys. So from lenders' perspective, their goal is to maximize the return. And I'm just wondering, where is that transparency between that lender's ultimate goal to get maximum return versus the interest rate somehow get calculated out of the loan level data available to consumers?
Sure.
Thank you.
So I guess the way we think about it as a 100% marketplace business, our skin in the game is transparency, right? By providing all of the data at the loan level about all the borrowers that we're serving, that's what keeps us honest and ensures for investors that we can deliver very stable, predictable returns. Now, we do think that there are some investors out there on some platforms where they're able to kind of arb the algorithm a little bit, but actually looking at our experience data, investors more or less are comfortable taking just an index of loans and understanding that the credit tier where we place someone is actually the credit tier where someone should be. There's not a lot of kind of alpha built in, if that makes sense. Rather, what people are doing is buying a portfolio of loans because ultimately credit risk is idiosyncratic. And what you want to do is make sure you understand the credit risk that you're getting. And that's where transparency really comes in. And the loan level of detail is just supporting that transparency. It's not so people can kind of pick the best loans, so to speak.
Next, who wants to ask a question? Up.
Hello, the question is going to all of you actually. You said there's a lot of potential to grow your business. And my question is, how attractive is it really to grow your business and your company? Because especially when you think about, you said your advantage is you are faster than the banks. So the more you grow, the more complex your business is going, and maybe the speed is lowering down. On the other side is also the regulation you said. At the moment, for sure, you have regulation, but I would assume that the bigger the company is, the more attention you get from the regulation side, and also everything about equity, core capital, and so on will influence your business. So that's why my question, how attractive is it really to grow your business? And until what point do you think it is still attractive?
Well, I think Tom should ask. Like Lending Club has grown. Obviously, there are 1,000 people, or more than 1,000 people, I think, now, and they've grown from a startup. And I think let's address the speed thing. I think that's an interesting piece.
Yeah, I can address both. We've got faster as we've got bigger. So we ship product faster, we deliver loans more quickly to customers. So I would simply reject the notion that getting bigger means you get slower. Banks are big and slow. That doesn't mean as we grow, we've gotten slower. And we're now delivering loans to consumers faster than we've ever done before. On the regulation part of the question, we are absolutely and completely regulated. There's no body of regulation that could possibly apply to us that we're not currently complying with. And so, our loans are actually issued by a bank because we have banks as big as Citibank, and it's hard to think of banks bigger than Citibank investing in our platform. The scrutiny that we have from them and from all of the various regulators that exist is literally it's hard to imagine it being anymore. And so this is not an under the radar business model that we're all running here. This is a business model that is firmly established and that already is operating within the regulatory framework that's here to stay.
If I can just add on to what Tom is saying, I think one of the important things about these businesses is that we've really focused on on building repeatable processes that scale quite well. That is really, as we've focused solely on the unsecured consumer space because we believe we have a core expertise in underwriting the consumer, and we've built a technology that is repeatable in just a few seconds. and it really allows us to continue the pace of growth that we've had. But of course, along with that comes the scaling of processes internally. And so at Prosper, we're very focused on the control mechanisms we have throughout the organization.
Yes. What percentage savings do you deliver over institutional, or sorry, over traditional, sorry, let's restart. What percentage savings do you deliver to borrowers, and what interest rates do you return to investors?
So for Lending Club, we deliver 31% savings to consumers. And investors typically are taking money out of their bank account and investing it with us. So they're going from a few basis points of return to roughly a 7 to 8% net return on their investment in Lending Club.
Funding Circle's case, I guess how I would put it is, on the safer end of the credit spectrum, meaning those loans where the price is lower, it should be roughly equivalent to how expensive a loan would be from a bank. We just get them that loan in a matter of days as opposed to months. So we save them a lot in terms of opportunity cost. And because of the sophistication of the credit evaluation that we're able to do and the efficiency we have from a technology processing perspective, we're able to return the vast majority of that yield back to our investors. So if you were to take a full index of all Funding Circle loans originated in the US, inception to date, and you were to net out our servicing fee and you were to net out losses, that return would be almost 12%. Because our interest rates range from 5.5% all the way up to 24%. So it's a very efficient mechanism both for the borrower and for the investor.
So you seems like both the targeting your segment as well as the underwriting process is pretty streamlined. Do you use big data right now in both of those? If not, how do you plan to use it, and how do you plan to improve on using it?
Yeah, so we use data to inform every next decision that we make. So, you know, who we're lending to, every aspect of it in our underwriting process. So, yes, we do. Can't give you every detail of it, and we have some proprietary products that we think about, but that's probably the key ingredient, that one of our key differentiators. And then just along the lines of speed, I mean, we do everything from, you know, we reduce every pixel of data that you have to input before we can give you back your rate. We've reduced the number of screens that you can literally put it into one screen, the workflow for the consumer, in every aspect of that, and getting to quicker speed, and the operator side of it, every single piece. And coming from the advertising business, innovation and taking every single minute and person touch out of that step is really innovation unto itself, and that just feeds on itself from a speed perspective.
I would also say the use of data is one of the differentiating pieces part of this industry. That the innovation that's happening is often, I mean, it's on the processes and the speed, but it's also on the data. They're pulling data sources that that banks haven't used effectively, and so that's, I think, the data, whether you call it big data or what, just the data that's being pulled it's more predictive, and it's been used in a more effective way than what the banks have traditionally done.
My question is, all these businesses are prevalent more in US, and how to launch similar marketplace lending businesses in countries where there is no strong commercially available credit information on individuals, like India or maybe Philippines.
Well, India, it's really just getting started. China is really the most interesting country because they don't have a strong credit bureau and a strong credit infrastructure, and it's by far the biggest market in the world, because where we have here people in this room, they can come and get a loan from these people, but most people have choices. You don't have to get a loan from the online platforms. You can go to a bank. In China, the vast majority of the middle class are unbanked, and that's the big difference. I think you're going to, with China and developing countries, it's going to become their banking system. This will be, if you're going to create a banking system in the 21st century, you wouldn't create what we already have. You would create something like we have here.